In this free video course, you will learn everything you need to know about risk management for trading stocks, crypto, forex, or any other financial market. By the end of this course, you will not only be able to manage risk correctly, but you will also learn about advanced risk management principles and techniques that most traders don't know about. Alright, so hello everyone and welcome to this full risk management trading course. Risk management is the most powerful skill you can learn in trading. And that is because even if you have a perfect trading strategy, you can still lose money if your risk management is off. You have probably heard the statistic that around 90% of traders lose money. And a huge reason for that is that I think that 90% of beginner traders don't take the time to sit down and watch a full course on risk management. So that is exactly what we're gonna do today. So make sure to get comfortable, grab your notebook and pen, maybe grab something to drink. And without further ado, let's dive right in to the course. All right, so let's begin here by taking a look at what you can expect to learn from this course. And first and foremost, before we can start using and mastering risk management, we of course first need to know a little bit about what risk actually is in the first place, and the very important rule that survival comes first. When it comes to trading, the most important thing is to actually survive so you can keep on playing the game. After that, it's time to take a look at the classical foundations behind modern risk management. So we will take a look at some of the risk management legends that you really need to learn about. After that, it's time to move on to some important practical concepts such as win rate, risk to reward, and the very important expectancy formula. This right here is probably one of the most important formulas in trading. And don't worry if you are a little bit intimidated perhaps by all the math on this image right here. Don't worry about it, because in this course I will break down everything in as simple terms as possible. So if you like math, you can dive deep into the formulas, but if you only want the practical insights, what you can walk away with today without any math, don't worry, because I will talk all about that as well. Next on, we will move on and take a look at things like stop losses and take profit types. You know, many of you guys probably are familiar with stop losses, but in this video, we will take a look at many different types and strategies we can use to set our stop loss, and that we will also do for the take profit. Next, we're also going to take a look at some position sizing models. And position sizing is basically about how much you are risking per trade. And here we have many interesting and useful formulas, such as the Kelly criterion, and we will take a look at some others as well. Last but not least, we will take a look at some risk transformation techniques, because we have many different types of risks, and we can actually in many cases transform one risk to another. And as I said, if this sounds complicated right now, don't worry, because that is how it's supposed to be. But after this course, you will walk away with a very, very good understanding of risk management, and as a result, you will make more money. And here I can also mention that I have built this course in a step-by-step manner, so I highly recommend to watch the chapters in order. So, for example, the chapter in the bottom here builds upon the previous chapter, which builds upon the previous chapter. So if you want to get the most out of the course, start from the beginning and watch all the way through the end. But I will also, of course, include YouTube timestamps. So if you want to jump around in the video or rewatch a part, you can do that as well. Alright guys, now let's jump into chapter 1. But alright, so now let's take a look at what risk actually is. As a trader, it's super important to understand what do we even talk about when we talk about risk. Well, first of all, there is a difference between uncertainty and risk. Uncertainty is basically the fact that we don't know what will happen next. Uncertainty is not knowing what happens next. And this is something that cannot be removed. So what do I mean by this? Well, every time you take a trade, no matter how good your setup is, no matter how good your trading strategy is, you can never be sure if the trade will succeed or not. There's always some uncertainty. But now you might wonder, then what is risk? Well, risk is the part of uncertainty that you can measure and choose. So for example, you can never know if a trade succeeds or not, but what you can know and what you can calculate is how much you will lose when or if the trade actually fails. So if we think about uncertainty as this whole circle right here, then risk would be a small part of uncertainty. So this small circle right here is risk, and this is the part of uncertainty that we actually can control. So just to repeat, you cannot know the next trade's outcome, but you can choose exactly how much you lose if you are wrong. So this is what this course is all about. You know, we want to focus on this part we can control, the part of risk, and we want to master it. So here, risk management, it's all about surviving first and profit second, because long-term traders are like slow ships and not speedboats. So if you look at this illustration right here, you can see to the left, we have a very large and majestic, sailboat, which is sailing through the storm without any problem. This right here is the long-term trader that survives even harsh conditions like storms. But if you are a trader that are, over leveraged and you are not taking risks seriously, yes, you might be faster than the slow ship right here. But if you are a reckless trader, a storm will eventually come. And when that storm comes, you will not be equipped to handle it. And it can lead to, devastating losses. Some traders even lose their whole account because they don't have the risk management in check. You have probably heard about people that blow up their account. This is something that should never happen and will never happen if you actually have your risk management in place. So be the slow and steady boat. Don't be the fast boat. Even if you might make, faster profits in the short term, in the long term, you will lose money. All right, so now it's time to take a look at the classical foundations of risk management. So I want to take a look at some of the most prominent people in the history of risk management. If you only learn about these four guys, I would say that you are ahead of definitely of most traders. And the first figure I want to mention here is Bernoulli, that introduced something known as expected utility all the way back in 1738. So here you can see an image of Bernoulli. I hope I pronounce it correct right here. And what he basically introduced was, as I said, expected utility. And in simple terms, expected utility basically tells us that people fear losses more than they enjoy gains. So if you really think about it, would you be more happy if someone gave you $100 or if you lost $100? For most people, the loss hurts much more than the gain. And this is what expected utility is about. And you might have felt this in trading too. So for example, winning in trading feels really good. But many times if you lose the same amount, let's say you win $1,000 on a great trade, that of course feels great. But doesn't it hurt more to lose $1,000? For most traders, by far the most common thing is that the losses hurt more. And that is very important to have in mind throughout the rest of the course. The next figure I want to talk about is Markowitz. And he actually won a Nobel Prize for showing that risk and not just return defines a portfolio. And this might sound a little bit complicated. What do I mean by this? Well, Markowitz here clearly described how risky individual assets are and why diversification is so key. So for example, let's say that we have two companies. We have one company that sells umbrellas and we have one company that sells sunscreen. When it comes to these companies, let's say we have a summer. The umbrella company will of course perform very well when it rains. So if it rains, this company will perform good. But the sunscreen company, when it rains, will of course perform, bad, right? Who wears sunscreen when it rains? However, the opposite is true for the umbrella company. When it's sunny, this company will not sell many umbrellas, while the sunscreen company is will perform, of course, very good. So the concept here is that, you know, alone these companies are much more risky because we can't control the weather. But if we combine these two risks together, the risks sort of take each other out. And that is what Markowitz portfolio theory is all about. Next up, just a few years later, we have Kelly. And Kelly basically built the formula that tells you how much to risk for maximum long-term growth. So he built a formula here for how much you should basically risk on trades. And this right here, known as optimal bet size, is a beautiful formula in theory. But as we will actually return to this one later on and talk a little bit about why following this formula can actually be so dangerous for traders. Because this formula is all about, you know, trading in a perfect world. But as you guys know, markets are far from perfect. They are manipulated and so on and so on. So we will actually talk a little bit about how we should approach the optimal bet size. So stay tuned for that later on in this course. Last but definitely not least, this is a much more modern concept. But here, Taleb in 2012 introduced what is known as anti-fragility. And anti-fragile systems are basically systems that gain from chaos instead of breaking under it. And here, when it comes to the real world, most things are actually fragile. So think about, for example, a wine glass. A wine glass works perfect in, you know, typical conditions when it is just on a table. You pour some wine, you know, nothing happens to the wine glass, everything is fine. But when something unexpected happens to the wine glass and it gets, you know, stressed for some reason, maybe it falls off the table, the wine glass breaks. So that is a fragile system, a system that breaks under stress. But an example of an anti-fragile system is a system that grows stronger when it's stressed. And one of the best examples for this, in my opinion, is muscles. Because, you know, in normal conditions, muscles, you know, of course works fine. But when we stress muscles, for example, when we work out, the muscles actually doesn't break like the wine glass. They might break a little bit during the workout, but they actually come back stronger. So an anti-fragile system is a system that gains from stress. And this is a very interesting concept that we will return to later on in this course. Alright, so now it's time to take a look at the asymmetry of profits and losses. And this right here is a pretty simple, but it's such an important concept to understand. And that is simply that a certain amount of loss requires more to recover. So, for example, a 10% loss will actually require an 11% gain to recover. So if your portfolio drops 10%, you will need to gain 11% to recover. But this is not too bad. As you can see on the image right here, a relatively small loss like 10%, yes, we need a little bit more to recover, but it's easily doable. But here, if we have a bigger loss, let's say we have a 50% loss, then we actually require 100% to recover. So here you start to notice that when we have bigger losses, the recovery, the amount needed to recover is much bigger. And if we have a devastating loss of, let's say, 90%, you can see here that we have, you know, we need around 900% gain to recover. So if you have a huge loss, like right here, of 90% or even more, you know, most traders will not recover from such a big loss. And, you know, the big key takeaway here is that we need to avoid big losses. Avoid big losses at all costs. It matters more than chasing big wins. Because let's say you can get multiple big wins in a row. So your portfolio might, you know, grow like this. But if you get a massive loss like 90%, the amount it takes to recover here is so much more. It's so much harder to recover compared to, you know, winning and growing an account. Super important to have in mind. But right, so now I want to jump into TradingView real quick here. TradingView is the platform I use for all my trading, all my technical analysis, and this is the platform I will use in this whole course. And I also, if you want to get started with TradingView, I do have a special link. You can use that link to get TradingView Premium for free for 30 days. And if you later on want to upgrade, you will also get a $15 bonus. So if you have been, considering TradingView, you can use that link. But the reason I want to open TradingView in this case is because I want to give you guys a clear example of the asymmetry of gains and losses. So for example, if we take a look at the last sort of bear market for Bitcoin that pretty much started up here back in 2021 and went on for a long time all the way to the end of 2023, we can use the tool right here. We can use the price range tool. And if we measure here from the all-time high down to the very low, you can see that we had a drop here of almost 80%. The drop was around 77%. So when the price dropped 77%, how much do we need to recover? Well, we can use the same tool once again, the price range tool, and take a look at, in order to recover back to the same price, the price now actually have to go up with not 77%. We have to go up with around 350% to recover the losses. So I hope this clearly demonstrates why it's so important to, protect the downside. Trading is more about protecting the downside than chasing the upside. Alright, so now it's time to take a look at 3 concepts that every single trader needs to learn by heart. And that is win rate, risk to reward, and very importantly, expectancy. And the first thing you really need to know is that win rate alone is actually meaningless, because a 30% win rate can actually be profitable, and an 80% win rate can lose money. Because let's say you have an 80% win rate, but when you win, let's say $100. And of course, if you have an 80% win rate, you have 20% to lose. But when you lose, you maybe lose $1,000. You can hopefully, just by looking at these numbers, see that even though we have an 80% win rate, we will lose money. And very soon I will show you guys a calculator you can use to calculate if your trading strategy is profitable or not. I will return to that very, very soon. But first of all, we need to take a look at something called risk to reward ratio, or for short RR. And risk to reward ratio is simply the size of your reward divided by the size of your risk. So if you, for example, win 3 times more than you lose, then your risk to reward is 3 divided by 1, which is simply 3. But if you lose 3 times more than you win, then your risk to reward is 1 divided by 3, which is simply a third. So it's always the reward divided by the risk. And to make this a bit simple, you can put in the actual numbers. So let's say that you win 100 when you win and you lose 50 when you lose. So we have the once again the reward divided by the risk, which in this case would give a risk to reward of 2. But right, so now I want to jump back here into TradingView, because I want to show you guys the risk to reward tool in TradingView, which is a very good tool you can use to plan your trade. And if I forgot to mention this the last time, we are currently looking here at Bitcoin, and we are on a daily time frame. So every candlestick you can see on this chart represents 1 day. But let's just say that we find a setup here. For example, let's say that we identified a trade right here. You can see that candle, this red candle right here, is what is known as a hammer pattern. And that is a bullish Japanese candlestick pattern that indicates a reversal, especially if it comes after a move, a strong move to the downside. So this right here, we also actually had volume. But that is a little bit outside the scope of this video. If you want to learn more about volume, I do have a full course on volume. I can link it in the video card and description. But as I said, what I want to do now is just to show you guys the risk to reward tool in TradingView. And to find that tool, you want to go here where it says forecasting and measurement tool. And here we have a tool called long position, and we also have one called short position. The tool, if you are betting that the price will go up, which is the most normal trade, you want to use the long position right here. Then you want to click on where you enter the trade. So the most common place to enter a hammer is at the candle close. So let's say that we enter right here. And when it comes to our stop loss, I will show you guys many methods to set stop loss later on in this course. And when it comes to hammers, I hope you can see the most common way to set your stop loss is to set it just below the lowest point of the hammer. So I set my stop loss right there. But now, remember here, the risk to reward ratio is how much do we win compared to how much we lose. So let me start here by dragging down the reward here to 1. So as you can see, right now we have a risk to reward ratio of 1 or 1.01, but basically 1. And that means that this part right here, the risk part, and this part right here, the reward part, is the exact same length. We risk as much as what we get in reward. But let's say here that we want to increase the risk to reward ratio to, let's say, 2. So if we increase the risk to reward ratio of 2, now we will win, this length right here is twice the size, which means that we will win twice as much compared to what we lose when we lose, because this is just 1x. So this is an example of a 2-to-1 risk to reward. And of course, if we increase this ratio even more, this right here is a risk to reward ratio of 3. Up here is a risk to reward ratio of 5, and so on and so on. But what I can also show you guys is, the opposite. So what we can do in trading, and that is one thing that is very nice about trading, is that we can make money when the price goes up, but we can also make money when the price goes down. So let's say that we identified a opportunity to make money when the price goes down, or in other words, shorting the market. What we then want to use is our short position right here. Let's say that we found an opportunity right here, and our stop loss is placed just above the pivot high of this move. Now, once again, you can see here, the risk to reward will work the exact same thing, but now our reward side will be to the downside. Remember, we make money when the price goes down. So a risk to reward ratio of 1 would look something like this. A risk to reward ratio of 3 would look something like this. A risk to reward ratio of 5 would look something like this. But yeah, in very simple terms, this is how you use the long position tool and short position tool in trading. In TradingView, it's a very easy way to plan out your trades using risk to reward. But now the next concept you need to understand is something known as break-even win rate. And the break-even win rate, if you take a look at this image right here, is basically the minimum win rate where you stop losing money. So if you have a certain risk to reward, the break-even win rate tell you, how often do I need to win to make money? And for this, we actually have a very simple math formula. It's not super important to learn, but if you want to, I can just write it down. It's basically 1 divided by 1 plus your risk to reward. So for example, if you have a risk to reward of 3, which is a common risk to reward ratio, then the formula would be 1 divided by 1 plus 3, which is equal to 1/4 or 25%. So that basically means, as you can see right here, that a risk reward of 1/3 only needs to win 25% of the time to break even. So if you win, for example, 30%, you will make money. But now last, but definitely not least, we need to learn about expectancy, or in other words, expected value. And the expected value is simply when you take your win rate and how much you win on average minus your lose rate times how much you lose your average. Because this is actually your real edge. This is how much you expect to earn per trade. So to teach you guys expected value, I'm going to use the trading toolkit we have here. This one is currently available for all our YouTube channel members, gold and higher. But don't worry about that, because now I just want to demonstrate how expected value work. So I go here to the MindMath, our trading tools, and then I go to expected value right here. So first of all, you need to enter your win rate of your trade. You need to enter how much you win on average and how much you lose on average. You can also enter here, how many trades you take per month to calculate how much money you will earn. But to keep it very simple, let's start here with a win rate of 50% and an average win of $100 and an average loss of $100. Now you can see in the box right here that we expect our expected dollar amount per trade is $0, and this is simply to understand. We have 50% to win 100, 50% to lose 100. But if we instead change the win rate here, so let's change the win rate to 66%. Now we have 66% to, win $100, which means that we have 33% to lose $100. Now you can see here that we expect to gain $32 per trade. But it's very important to still understand that, this doesn't mean that we will get $32 for every single trade. This is, on average, we will get $32. So you can still have losing streaks. You might lose, 2 times in a row or even 3 times in a row and so on and so on. But if you take a large amount of trades with this exact setup, you will make money. And you can see here in this calculator, you will get, how much you are expected to earn over 20 trades. So here you expect to earn $640 over 20 trades. And you can also see that at this pace, that's about, $7,680 per year if you take 20 trades per month. And you can see that these numbers will get even better if you, for example, have a larger average win. Let's say we have a 66% win rate with a 2-to-1 risk to reward ratio. So remember, now our reward is twice the size as our risk. Now you can see that the numbers are much better. We expect to win around almost $100 per trade, which gives us around $2,000 for 20 trades and around, as you can see right here, around $23,500 per year if you take 20 trades per month. And you can also, of course, see here the reward to risk ratio right here. Here we have a 2-to-1 reward to risk. And you can see here that you also get down in the bottom that you only need to win 33% of the time to break even. You don't need to win often. You need your wins bigger than your losses. So yeah, guys, I really hope this calculator helped you guys to understand expected value. As I said, this is one of the most important things you can learn and calculate as a trader. All right, so now the time has come to take a look at the magic of compounding and the compound effect, or in other words, the interest on interest effect. It has many names. This is really one of these things that are so important to understand, not only in trading, not only in investing, but just in life in general. I think that most things in life compounds over time. So this is just, no matter, where you are in life or what you're doing, this is so important to understand. And here, to begin, I just want to explain super quickly what the compound effect is. And in super simple terms, it basically is the effect that growth builds upon the previous growth. So what do I mean by this? Well, let's say we have, an investor or a trader that starts with $100, and then during the first month or something like that, let's say it grows with, let's say 10%. Then it grows to 110. But if it grows, 10%, let's say the next month, it grows 10% again. This time, it doesn't just grow with $10 like it did the first time. This time, it actually grows to 121. So in the first growth, it grew by $10. Next, it grows with 11. And if we continue this process, it will grow even more and even more. So this principle is all about that growth builds upon the previous growth. And when we're talking about $100, it might not look or sound like a lot. But when we are talking about lots of money, and when we really let the time work for us, this effect can be so dramatic. And this is one of these things that really differentiates, rich people from poor people. Rich people really understand the magic of compounding. So for example here, Charlie Munger, who was, a legendary investor and just a thinker, he has a great book. He has a really great book that is called Poor Charlie's Almanac. I can highly recommend reading this book. It's, both about investing, but I would say it's more about general principles and ways to think to not just succeed in investing or trading, but rather to succeed in life in general. But anyway, one of the most important rules Charlie Munger have is never interrupt compounding unnecessarily. So if you have something that grows over time, like money, you don't want to interrupt this effect. And here, in the compound interest formula, the most important factor is time and not return. And the lesson from this is that if you have two traders, you have one trader that is, slowly and steadily making profits over years and years and years, he will actually beat a trader that maybe makes much more profit but is only trading for a few years. Being able to compound your capital over time beats, the fast and exciting way many traders nowadays try to trade. They try to, become rich quick. They try to become millionaires overnight, and that is usually, the fastest way to become poor quick. So here, for us traders, it's very, very important that we are reinvesting our profits. This is what turns, a small trading edge into life-changing wealth. So for example, if you look at this image up here, you can see that if we are a trader that, we reinvest our profit, so we make a little profit, we put this profit into our trading account, this means that our next trade can, grow even faster, which means that our next trade, we have even more capital, so we can make even more money on our next trade, and so on and so on. This is how we make tons of money. You might have heard that there are many sayings that say, the easiest way to make money is to already have money. And that is so, so true. And this is because of the compounding effect. But if you instead are a trader that, interrupts the compounding, remember that is the thing that Charlie Munger says that you really should not do. So if you are, all the time you are taking out money from your trading account, you maybe make a little bit of money, but you take out 90% of your profit. You make a little bit more money, you take out more money, and so on and so on. You can see here that the growth is so much slower on the red image right here. So one of the most important takeaways from this whole slide is that withdrawing profits to sort of live off trading, or even worse, if you all the time withdraw profits to buy fancy cars or this and that. Of course, you can do a little bit of that. I'm not saying that you need to reinvest every single dollar you make, but in general, withdrawing profits to live off trading is the most expensive habit a trader can build. So as a general rule of thumb, you want to be reinvesting your growth if you want to become really rich over time. All right, so now it's time to take a look at the 3 types of risk that is in every trade. So for every single trade you take, you will have 3 different kinds of risk. And the first one and easiest one here is the capital risk. And what is capital risk? Well, capital risk is simply how much money you lose if your stop loss is hit. So as a super simple example, let's say that you buy 1 Bitcoin at $100,000. So you buy 1 Bitcoin at 100,000, and if you set your stop loss, so let's say you set your stop loss at, $99,000, the capital risk here, or in other words, the money you lose if your stop loss get hit, will simply be $1,000. But here we also have another risk type, and this risk type is called positional risk. And positional risk is the chance that your stop loss get hits at all. So for example, let's still imagine that we bought Bitcoin at $100,000, but if we change our stop loss here, let's make the stop loss tighter. So let's change our stop loss to 99,500. Now you can see that we actually have less capital risk, but we have a tighter stop loss. And it's actually more likely that this stop loss gets hit because, the price can move something like this, hit the stop loss at 99,500 and then reverse. This is, of course, a possible scenario. And this is what we mean by positional risk. If we have a tighter stop loss, we have a higher positional risk. But at the same time, let's say we have a wider stop loss. Let's say we have a stop loss here at 98,000. In this case, we have, a lower positional risk because it's less likely that our stop loss gets hit. But here, the third type that is very important is a risk type called target risk. And this right here is the chance that you will make less profit than the trade was capable of. So this is basically all the scenarios where you either don't hit your target or if you are scaling out. So scaling out basically means to take partial profit before your real target is hit, and we will talk about that later on. But the important takeaway here, the key takeaway that you need to write down, is that you cannot actually eliminate risk. You can only move it from one type to another. And let me quickly jump into TradingView to show you this. All right, so here we are back in TradingView, and we are still here on Bitcoin on the daily time frame. But now let me actually just show you real quick here how the risks work. So let's just say that we open a random long position just to show you guys at $100,000. And let's begin here by, let's say we set our stop loss here at $98,000. In this case, it's very simple to understand that our capital risk, the amount of money we risk if we buy one Bitcoin at $100,000 and have our stop loss at $98,000, it means that our capital risk is $2,000. So we risk of losing $2,000. But now, in this case, you can see that the stop loss is pretty tight, right? So it's pretty likely that the price goes down here and hit our stop loss and then maybe reverses. So here we have a pretty high positional risk. And if we want to decrease our positional risk, we need to make a wider stop loss. So let's say we make our stop loss all the way down here at 95,000. So now we have, we have a better positional risk. But now you will realize that in this case, we have a higher capital risk, right? Because now if our stop loss get hit, we lose $5,000. And this is what I mean about that risks can, only be transformed. When we make one risk better, the other one will get worse. And the same thing is also true with target risk. So let's say in this case, maybe, the price start to move in our direction. What we can do here is that we can, move up our stop loss, for example, to our entry point. In this case, we completely eliminate the chance, the risk of losing money. So we eliminate our capital risk, but in this case, we make the positional risk worse, and so on and so on. I hope this example demonstrates how risks can only be transformed. But right, so now it's finally time to take a look at stop loss types. This right here is a skill that every single trader needs to master. And we have, in general, I would say that we have three main types of stop losses. And the first stop loss here is a technical stop loss. And what do I mean by this? Well, a technical stop loss is a stop loss that is placed where the trade idea is invalidated. So this is often, for example, behind a key level. So if you look at this image right here, you can see that in this case, let's say that, as you can see on the image, let's say we just enter the trade right here. Then an example of a technical stop is to place the stop loss somewhere here, for example, below the swing low. So here we have the swing low, and we set the stop loss, a certain distance below the swing low. This is a very common example of a technical stop. We place it just beyond the structure, for example, a swing low, or it might be, a support or resistance level, or a supply and demand zone, and so on and so on. But here, the other key type of stop losses is the volatility stop loss. And this is when we placed a stop loss based on, for example, a multiple of the ATR. The ATR is a very common indicator that we use to measure volatility, and I will show you guys this indicator very soon. But in general, the ATR, increases when the price moves a lot. You can think about volatility as how much the price is moving around its average. For example, around a moving average. To demonstrate this very clearly, a low volatility market might move a little bit up and down like this, while a volatile market moves much more like this. The swings in a volatile market are much more extreme. So that is another stop loss type. But the third stop loss type here is actually to combine both methods. So we use both a technical and a volatility stop loss. So we might, for example, place our stop loss below a key level, but then we might, leave some wiggle room here, and we can base the wiggle room on the volatility itself. And here, one very important thing to have in mind, you can write this down, is that you really want to avoid, for example, mental stop loss. So this is when you enter a trade and you think to yourself that, I promise that I will sell when this happens. No, you should pretty much always place a hard stop loss that, you set it so it automatically sells at that level. There are also some other stop types, like, for example, money stop losses, time-based stop losses that in general you want to avoid. I really recommend to focus on these types: the technical, the volatility, and the combined stop loss. All right, so now let's jump back here into TradingView. We are still on the same chart. I will try to keep it on this chart the whole course. We are looking at Bitcoin on the daily time frame, so you guys can see that all of these concepts you can apply to any chart. It doesn't matter if you trade crypto, if you trade stocks or forex. These concepts are the same. But now I want to show you guys the different stop loss types. And to do this, let's say that we identified a trade right here. So let's say for some reason we have been doing our technical analysis. Don't worry about how we did this, but let's say that we identified an entry point right here. So what we now do is that we are betting that the market will go up. So we will use our long position and press right here, which means that we enter right there. Now I want to show you guys the 3 different kinds of stop losses, and let's begin here with the technical stop loss. So the technical stop loss, remember, is when we place the stop loss often above or below a key level. And in this particular case, you can see that this was a case where the price actually bounced not only 1 time, but 2 times at this level right here. So a very, common way to set your stop loss in this case is to place your stop loss just beyond that level. So this right here is a very simple example of a technical stop loss. But now I also want to show you guys the volatility based stop loss. And in order to do this, we need to use some kind of indicator, or we need something to measure volatility. And to do this, we can go up here to the indicators tab in TradingView, and let me delete that, and we can search for ATR. This right here stands for average true range and is one of the most common indicators to measure volatility. As you can see here in TradingView, we also have tons of different versions of the ATR indicators. These are actually indicators that are created by the TradingView community, and that is one thing I really like about TradingView in general, that we have such a large community with many traders creating different versions and trying to improve on indicators and so on and so on. So I can once again remind you guys that if you want full access to TradingView, I do have a special link. It will be in the pinned comment as well as the description. But now guys, let's open up the average true range indicator. Now you might wonder, how do we read this indicator? Well, the basics is that the higher this indicator is, so for example, up here, when the indicator is high, it means that we're having high volatility. And you can hopefully see that on the price, that when the ATR is high, the price movement is moving up and down a lot in a sort of violent fashion. While when the ATR is lower, like for example this period right here, we usually have smaller candles and a little bit less volatility. But now then, how do we place our stop loss based on the ATR? Well, a very common rule of thumb is that we usually want the stop loss to be 1.5 to 2x the ATR. And what do I mean by this? Well, if we take our mouse here to where we enter the candle, where we entered the trade, and then we go down here to the ATR, we can read here that on this point, the ATR is 4,200. So using this rule right here of 1.5 to 2x, let's use the 2x rule for simple terms. That means that our stop loss should be around $8,000, because remember the ATR was around $4,000. So how do we do this? Well, we go to our stop loss, and you can see here that in this case we were actually in one sense kind of lucky, because you can see that our stop loss is already right here. We actually are at around 8,000. We actually are at around the 2 times the ATR. This was just random. So you can see right here, I hope you can see right here. This is the amount. So the stop loss is now around $8,000 from our entry level. And remember, our entry level was right here. But let's say that we used the 1.5 ATR rule. That means that our stop loss should maybe be at around $6,000. So if we use the 1.5 ATR rule, our stop loss would be somewhere around here. I hope you can see, because now the stop loss is around $6,000 from the entry point. But now, last but not least, let's use the combined stop loss. So remember, for the combined stop loss, we combine both approaches. So first of all, we want to set our stop loss below the key level right here. But for the combined stop, we usually add a little bit of wiggle room, and this is usually around 0.25 to 0.5x the ATR. And in this case, remember, we have an ATR of around 4,000. So if we use the 0.25 wiggle room, we should add around $1,000 of wiggle room for the ATR. So we take a look at the technical stop loss, which was at around 8,200. We add another 1,000 to 9,200. And now you can see that we have a little bit of room here between the technical level, which is right here, and the actual stop. We have a little bit of wiggle room right there. And one reason why this kind of stop loss is so good is that we allow for the price. So imagine if the price goes down here and maybe want to test this low once again. Remember, a common chart pattern is the double bottom chart pattern. So many times the price want to go down here, test this low, and then continue to the upside. By having this combined stop loss method, we can allow for this to happen and still make money. And by the way, guys, the double bottom pattern is just one of so many chart patterns that you need to learn. And if you want to learn all of the most important chart patterns, I do have a full course about that, and I will make sure to link that course both up in the video card as well as in the description below. But alright, so now it's finally time to take a look at take profit types. You know, when we talk about risk management in trading, we usually think about, stop losses and position sizing and so on and so on. But, being able to take profit successfully, this is so important, because this is, when we lock in profit. This is when we, actually make money. So being good at taking profits is, so important. So here we're going to talk about some of the best ways to do this, some of the best ways to take profits. And the first one, and the most common one, is to use a fixed R multiple. So this is super simple. This is basically when we have a target level that is X times your stop size. A super simple example, let's say we have our entry right here, we have our stop right here. And if we use this fixed R multiple and have our target up here, we can just simply say that our target should be twice the size compared to the length here between our entry and our stop. So this is when we use a fixed R multiple. But another way to take profits, which can be super useful, is to use a technical target. So this is basically when we place our target level at the next, for example, major support or resistance, or supply and demand, or liquidity zone. So for example, as you can see on the image right here, this is an example. Let's say, you enter your trade right here, maybe at a support or demand zone, but you have done your analysis and you know that a resistance or supply zone is up here. Then what you might want to do is take your target just before we reach that zone, because when we reach that zone, on supply zones, we usually see selling pressure. So we want to take our target preferably before we hit that resistance zone. And here, a third way to take targets is to use a dynamic target. And this is basically a target that is moved during the trade to sort of ride or extend the move. So here we can use things like, for example, channels, we can use Bollinger Bands, we can use pitchforks, and so on and so on. And a pro tip here is that if your trading setup maybe is technically valid, but you have a strong sort of support or resistance or any other kind of technical level nearby, you might actually want to skip that trade. So let's say that for some reason, let me delete that. Let's say that we have, we're trading right here, and maybe we found a good, buying opportunity at this point right here. But here, maybe for some reason, maybe in the past, we know that this was a strong resistance level. So maybe we have a resistance area right here that extends like this. Because we have a resistance area so close to the entry level, this right here is a trade we probably want to avoid. But right, so now let's jump back into TradingView and let's take a look here quickly at the different types of ways to take targets. And remember, the first way to take targets is to use a fixed risk to reward ratio. So for example, a very common fixed risk to reward ratio is 2, and this is, remember, simply that this distance right here down to the entry point is twice the size compared to this distance right here from the stop loss to the entry point. So a very common risk to reward is to set it at a risk to reward ratio of 2. You can also, for example, use a 3 to 1 risk to reward or a 1.5, but I would say that a 2 to 1 risk to reward is the most common one. And next we have the technical profit target level. And remember, this is when we base our target on a key level. And in this case, we can actually see that it's pretty clear that we had some resistance coming in right here, right? You can see the price got rejected not only 1 time, 2 times, 3 times. You can see multiple times we got rejected at that specific level. So what we can do is that we can draw some sort of resistance level. What I like to do in TradingView is that I usually use the rectangle tool right here. I try to include the most significant touches of this zone, and then I drag it to the right. So in this case, a target level that would make sense based on the technicals would be to set your target just below this level. And the reason we set it below is that we do expect that if or when the price reaches this point, we do expect the price to pull back. And in this case, you can see that the price went slightly above this level and then quickly below. And we did indeed see some selling pressure coming in at that level. But right, so now the third type to take target, remember, that is the dynamic type. So this is if we can zoom out and maybe find some sort of a trend, or we can use indicators like Bollinger Band and so on and so on. So, I'm not saying that this is a good trend line, but maybe we just had a trend line, maybe drawn something like this. Then a dynamic target could maybe be to, sit in the trade until we actually reach the trend line. So in this case, we might have not taken profit until all the way up here, right? When we actually reached the trend line. Another way to use some sort of dynamic support is to use an indicator. We can, for example, use, let's say, Bollinger Bands. So we open up the indicator tab here in TradingView and we click Bollinger Bands. So maybe we can use the Bollinger Bands here. And remember, we entered right here. And maybe our rule is to not exit the trade until we, for example, get a candle close above the Bollinger Band. This is just one example of rule, and there are many different ways to use dynamic targets. But all you need to know right now is that dynamic targets is targets that moves together with the price. They are not fixed at a certain place. They will change along with the price, just like this Bollinger Band does. But right, so now it's time to take a look at position sizing models. And remember here that if you want to be a successful trader, the most important long-term thing is not to maximize your upside. The most important thing is to limit your downside so you can, so you can be in the trading game for a long term and let your money grow and compound. And position sizing is how we make sure that we stay in the game. And here there are multiple different models, position sizing models that you need to know about. And the first model is called fixed fractional position size. And this one is super simple. This is basically when you risk a fixed percent of your capital per trade. So a very common number and a very safe number is to only risk 1% of your capital per trade. This is not a hard rule. Some traders risk 2%, some traders risk 4%, and so on and so on. But the important part here is that you are consistent and that you have a relatively small number. So just as a simple example, let's say you have an account size of 10,000 US dollars. And if you use a position size of 1%, that simply means that you should risk $100 per trade, right? If you use a 2%, if you use a 2% position size, you risk $200 per trade, and so on and so on. So as you can see, if you only risk this small amount per trade, you know, the risk of ruin your account on one trade is basically gone. So this is a super, super good method to, you know, really play it safe. So you can see this right here. This is the fixed fractional method. Another way to position size, which can feel even more simple, is to have a fixed dollar risk. So this is when you risk the same dollar amount per trade regardless of account size. So this can be, you know, just for peace of mind and so much easier to calculate. This can actually be a good idea. So for example, you might not want to, you know, calculate your exact, you know, account balance and position size every single trade. So you might do something like calculating your fixed fractional position size maybe once a week or something like that, and then you use that amount as your fixed dollar risk amount. So let's use the same example as before. You have an account size of 10,000, you have a position size of 1%, which means that you risk 100. If you use this combined method, your account, you know, might change a little bit. It might, for example, change from, you know, 10,000 to, let's say, 10,500 from one day to another. But to keep it simple, you can still risk 100 and 100 again until you recalculate your fixed fractional. A third way to size your positions is to use a volatility-based sizing. And this is when your position size shrinks in volatile market and it grows in quiet ones. All right, so to demonstrate this, let's go back here to our trading toolkit, and you want to make sure that you are here on the position size page. And let's keep it simple. Let's say we have an account size of 10,000. We risk 1% per trade. And let's say our entry price is at 100 and our stop at 95, our take profit at 110. With this setup right here, we need to buy 20 units. Why? Well, because 20 times 5, remember here we lose 5 per contract, is equal to 100. And since we risk 1% of 10,000, that is 100. So that right there is the math. But here, when it comes to the volatility-based position size, remember here that when the volatility increases, we need to increase the distance of our stop loss. So that is, for example, when we use the ATR indicator. When the ATR is high, our distance to the stop loss will be larger. So as you can see here, if we increase the distance of our stop loss from 95 to 90, that means that we now only buy 10 units instead. Or in other words, our position size is actually decreasing. We're holding a smaller size here. So as you can see here on the volatility-based sizing, when we have low volatility, the size here gets bigger. And when we have high volatility here, we need to decrease the size. Yet another way to position size is something known as fixed ratio. I think it was popularized here by Ryan Jones. And this is basically when your position size only increases after a defined profit milestone. So this is basically when you set up for yourself that you're only able to risk maybe let's say $100 until you reach a certain, you know, profit target, or until you reach a certain account balance. And then after that, after the second profit milestone, you might be able to risk, you know, 200 per trade instead. This is a method I don't really recommend. For most beginners, keeping it simple with fixed fractional or fixed dollar risk is the way to go. And if you want to be a little bit more advanced, you can definitely include volatility into the picture. All right, so now the time has come to take a look at the Kelly criterion and why full Kelly will ruin you. So first of all, you might of course wonder what the Kelly criterion is. Well, the Kelly criterion is a mathematical formula developed by John Kelly in 1956. And the formula answers one question. What percentage of my account should I bet on this trade to grow my wealth as fast as possible without going broke? And the formula John Kelly developed is simply this. The percent you should risk is simply your win rate minus your loss rate divided by your risk to reward. So to simplify, your percent to risk is equal to your percent win rate minus your percent of losing divided by your risk to reward. And here it's very, very important. In order for this formula to, work, even to work in theory, you need to have very good numbers of both your win rate and your risk to reward. So in order to use this formula, you need to have performed, good back tests. So you actually have, correct data on your win rate and lose rate and so on and so on. So to keep it simple, let's make an example here. Let's say that you have back tested, maybe you have back tested at least 100 trades, and you have, according to your test, you have a win rate of 60%, which of course means that you have a lose rate of 40%. And let's say that in this case you had a risk to reward of, to keep it simple, 1-to-1. So you won on average, let's say $100, and you lost on average, let's say $100. So now to calculate the Kelly criterion, so how much we should risk, we simply plug in the numbers. So the amount we need to risk is simply 60%, or in other words, 0.60 minus, remember, our loss rate, which is 0.4, or in other words, 40%, and divided by your risk to reward. And remember, here we have divided by 1, which is just equal to 0.60 minus 0.40 here, which is 0.20, or in other words, 20%. So according to the Kelly formula, if you have these stats, you should bet 20% of your account on every single trade. And this is actually a super, super large amount. Remember from earlier in the course, we talked about that a conservative amount is maybe to bet 1% or 2%. But according to this formula, you should bet 20%. And the very important thing to notice about the Kelly formula is that this is the formula that grows your account in theory as fast as possible. But in real markets, remember, even if you have done a good back test and according to your back test, your win rate is 60%. If something happens, which always happens in markets, your statistics are never perfect. Anything can happen in markets. If your win rate is just a little bit off, the full Kelly can lead to devastating results, and it can basically blow up your account. And this is what I tried to demonstrate with this image right here. So while a full Kelly, so the full Kelly here is the red line. So you can see that the full Kelly can grow your account super, super fast, and it will often lead to very explosive swings here, both to the upside and the downside. But when something unexpected happened that maybe is not, catched by your statistic, this can actually blow up your account, take your account pretty much to zero. So in real markets, I definitely don't recommend to use the full Kelly. But there are actually examples of traders that have used the full Kelly successfully. One example here is Larry Williams, who used the Kelly formula for his risk management to turn around $10,000 to roughly $1.1 million in the 1987 Robbins Cup. But later on, Larry Williams actually admitted that he was super lucky during this cup, and that using full Kelly like he did is not a sustainable way to trade. And a big reason here, as I mentioned earlier, is that the full Kelly formula assumes that your stats are constant, which is never really true in real markets. As I said, if you have miscalculated your win rate with just a few percent, it can lead to devastating losses. So that is why if you use if you want to use the Kelly formula, I recommend to either use half Kelly. So that is simply, instead of recently we calculated 20%, Half Kelly would be to use 10% instead. But I actually, for most traders, especially if you are not, an advanced trader and you really know your stats, I recommend to go even lower, maybe a quarter Kelly, down to around 5%. And if you are not even sure about your stats, I recommend to do the more standard risk, position sizings of maybe 2% or 1%. Because remember here, our main goal as traders is to stay in the game and keep playing. As long as we can keep playing, we learn more, we improve our statistics, and that is how we can compound our wealth over time. Alright, so now it's time to take a look at averaging down and something, a technique known as martingale. But the first thing we need to know is, of course, what is averaging down? And in very simple terms, averaging down is when you are adding to a losing position to lower your average entry price. So for example, let's say that you buy 10 stocks here for, let's say, $100. And then for some reason, the price drops down here to $90. If you now buy 10 more stocks, the total amount you have spent is, 10 times 100 plus 10 times 90, right? Which is equal to 1,900. Which means that the average you have spent here is 1,900 divided by 20, right? Because remember, we have bought a total of 20 shares. And this is just 190 divided by 2, which is equal to 95. So you can see that by doing this, our average price will now be $95 instead. And this is a super simple example of how averaging down works. You buy at lower prices to get, a better total entry price, and it will be, much easier to, or it will become much quicker to recover as long as you keep averaging down. But there are many hidden traps, and many, averaging down is one of these things that are, I would say, one of the main reasons why traders blow up their accounts. There are lots of psychology behind this. Many traders feel like, when the price starts dropping, they start to add more. When it drops even more, they add even more because they try to make the money back. And that is, such a slippery slope to blowing up your whole account. But there are sort of good ways to average down, and there are bad ways. So first of all, let's talk about, smart averaging. And this is when you have a pre-made plan. So you plan a max position size. So even before you take the trade, you plan that if the price will go here, I will add. If the price drop even lower, I will add a little bit lower. But you need to, in advance, plan exactly how you do this. So you scale in at predefined levels to have a better average price. So there are multiple ways to do this. You can, for example, do linear averaging. And this is when you add the same size at each level. So an example is this right here. So linear averaging, you can see right here, you add, for example, the price goes down to one level, you add the same amount as you started, it goes down to another level, you add, 1x, another level, 1x, and so on, same amount every time. But you can also do some kind of non-linear averaging, right? So this is when you use a larger, you use a larger size at later levels for an even better average price. So we can once again do the example here of, let's say that you buy, to keep it super simple, let's say that you buy one stock at 100, then the price drops down here to 90, and now you maybe add 2 stocks instead. So you double the size. In the beginning, you bought one stock, it goes down to 90, and you buy 2. Now the average price will simply be 100 plus 90 times 2, which is equal to 280. And to get the average price, we simply take 280 divided by 3, which is basically equal to 93.333. So you can see in this case, because we add more down here, we get an even lower 93.3. We get an even lower sort of average price than if we add equal weights. So this is how non-linear averaging work. But we also have a very brutal method to add to trades. And this is what is known as the martingale method. And this is basically when we double the size after every loss. And in one sense, or in theory, this actually guarantees recovery. But this is a very, very scary mindset to have, because this only works if you have an infinite amount of capital. So to show you how this works in theory, let's say that you have, let's say that I give you a bet that you have a 50% chance of winning, and of course 50% chance risk of losing. So think about it as, you know, flipping a coin or anything. And let's say that we begin with $100, so you can either win or lose $100. But let's say that you lost the first one. What you can now do is that if you double the bet size, so now you have 50% to win or lose $200. And let's say that you lose once again, so now you lose 200. But what you do is that you once again double the bet size. So you have once again 50% chance to win or lose 400. But let's say that you lost 400, and this can go on and go on. But as long as we double the bet size, so let's do once again, we have 50% chance to win or lose 800. Let's say that this time we win, so we win 800. Now what you can see is that this 800 actually covers all the losses here, because we have a total loss of 700. So as long as you keep on doubling and doubling and doubling, when you actually win, you will make back your money. But as I said, and this is super important, this only works if you have infinite capital. Because if you come to a point where you don't have any money left, you have basically lost everything. So that is why, that is why I have this image right here. The martingale technique here can be very tempting because in theory it works, but it's super dangerous in reality because it can lead to devastating losses. If you reach your capital limit, it's basically game over. But right, so now I want to talk a little bit about going beyond directional trading and talk a little bit about anti-fragility. And here, what I have been talking about so far in this course is mostly related to directional trading. Directional trading is simply when we bet that the market will either go up or go down. And directional trading is, what my YouTube channel, at least so far, is mostly about. So as I said, directional trading is betting on which way the price moves. And this is, a super hard game. But there is another game as well, and that are to use anti-fragile strategies. So these are strategies. Remember what I said earlier in the course. Anti-fragile systems are systems that grows or benefits from chaos. So one example I talked about is muscles. Muscles are anti-fragile because they actually grow stronger when they are under stress. For example, when you work out, you stress your muscles and they grow stronger. Anti-fragile strategies work in a similar manner because when you use anti-fragile strategies, you profit from volatility itself instead of guessing direction. So you can actually sort of bet on chaos instead of direction. So if you trade, in a normal way, you bet the way which the market goes, you don't really profit if the price goes sideways. But if you bet on volatility, you can actually profit from large swings in the market, even though it doesn't matter in which direction. And this is something I'm if you guys want to see, I can actually make a course in the future about anti-fragile trading strategies. So let me know in the comments if you want to see that. I would love to hear if you guys would be interested in that. But I can just mention here that the math, or at least some math of anti-fragile strategies, come from Black-Scholes, which won the Nobel Prize here in 1997. And that is, how banks, or at least how many banks, actually trade. But right, okay, so this course is getting super long, so I think it's time to start wrapping up here. But before we do that, I just want to mention that if this video helped you out in any way, I would so appreciate if you can show that by dropping a like on the video. That is the simple, free way to help out the channel, and it helps out more than you think. Also, if you made it all the way to the end of this risk management course, make sure to drop down in the comments, write full course in the comments to just prove that you watched all the way to the end. You can also, if you want to, comment your biggest risk management mistake. So have you made yourself any of the mistakes I have been talking about in this video? And you can also comment your most significant learnings from this course. You know, what did you find most helpful? And of course, guys, make sure to subscribe for more in-depth trading courses like this one right here. But right, guys, so now when you know risk management, you are set up to start your trading journey. So when you have the time, I highly recommend check out this playlist right here. Here you can find all my free trading courses right here on YouTube.